Hi, everybody. This is Alan Ellman, the Blue Collar Investor, with this BCI podcast number 42 titled, Why Was My Short Out of the Money Put Exercised? And we're going to use a real life example with the Boeing company, which trades on the New York Stock Exchange under the ticker symbol BA. Well, as most of us know, when an option is out of the money as expiration is approaching, it generally will not be exercised. It just is not in the favor of the option holder to do so. But there are some situations, rare situations, when this may not be true. This podcast will focus in on one of those scenarios. Let's first have a look at what selling out of the money cash secure puts involves. Well, we must first select the stock that we like that's eligible for option selling, and then sell a put option at a strike which is lower than the current market value of the stock. So an out of the money put means the strike price is lower than the current market value. Now, the broker will require most retail investors like ourselves to put aside a certain amount of cash in case the put is exercised and those shares are put to us. We have to pay for them. So the formula for the amount of cash the broker will require us to put aside is the put strike minus the put premium times 100 and then times the number of contracts. So as an example, if we sold a 45 put for $2, the broker would require us to put in 45 minus 2, which is 43 times 100, $4,300 per contract. If we sold 2 contracts, $8,600. So that's the amount of cash that will be required to secure that put. Now, exercise of that put will occur if the price of the stock drops from 45 to below the put strike. So if it's anything under the put strike of 45, that option will be exercised and the shares will be put to us. So that means when the put expires in the money. But there are some rare exceptions, and that's what this podcast will focus in on. We're going to use a real life example with Boeing, which on April 1st, 2019 was trading at $395.24 per share. The out of the money 390 strike put was sold. Now, 4 days later, Boeing was trading at $391.93, leaving that 390 put strike still out of the money. As the market was closing, that's where the stock was trading. So we had an out of the money put strike. What happened? The next day, after expiration Friday, the put option was in fact exercised, and the seller of that put option had to purchase the shares at $390. What happened? Let's first have a look at the mechanics of exercise. Now, out of the money strikes are almost never exercised. The key word here is almost. The market maker, however, has 90 minutes after the market closes, after 4 p.m. Eastern Time, on expiration Friday, to inform the Options Clearing Corporation as to what action, if any, to take. Now, the option can expire worthless, or the market maker can inform the OCC that it wants to exercise. And that's within that 90-minute time frame. So let's go back in time now to 4 p.m. Eastern Time on April 5th, 2019, when it appeared that that $390 put option was expiring out of the money. Shortly after the market closed, there was an announcement that Boeing was going to cut back on production of their 737 MAX jets. And that was after there were 2 plane crashes relating to that type of jet. Now, the news was published in that 90-minute time frame. So a lot of the professional analysis was that Boeing was going to open up on Monday morning at a price lower than 390. If that's the case, then 390 would then be in the money, no longer out of the money when the market opened that money, even though the option was already expired. So that was the basis that made exercise appealing to the market makers. Now, by selling the selling the shares at 390, when the expectation was that Boeing could open up lower on Monday, was creating a benefit to the put buyers and creating risk to the put sellers, us. What happened on Monday, April 8th? Well, Boeing was trading at 377, $13 lower than the strike price. So if the shares were put to us at 390 on Monday, the first day of the new contract, put sellers were in the hole by $13 a share. If we looked at a chart, it would be so graphically obvious that on Monday there was a huge drop, and that was based on the information that came out after the market closed on Friday. But the market makers had the advantage of exercising that option based on this new information, and many of them did. And then after that, Boeing continued to move down in price, but the big drop was on the Monday after expiration. So let's summarize now. Assignment risk, if news comes out in that 90-minute window after expiration, is something that option sellers have to live with. It may look like the option is expiring out of the money, and in fact, some unexpected news comes out that changes everything. So we have to be careful of stocks that are generating a significant amount of risky news, which was actually the case with Boeing. Remember, I mentioned that it had experienced 2 plane crashes with that particular jet. So it was already a risky stock to own. Perhaps not the best stock to own based on the information that came out even before expiration. So just one of the things, even though it's so rare that this happens, one of the things that I believe we should all be aware of, that there is this kind of unusual rare risk of some news coming out in that 90-minute window after expiration happens on the third Friday of the month, 4 p.m. Eastern time. And before I go, let me just remind everybody that we have a whole lot of free resources on the website, www.thebluecollarinvestor.com. If you look at the top black bar where it says free resources, including the Elman calculator, you can download that calculator, a put selling calculator, and several other files that will assist in elevating our returns from option selling. There are videos. There's a beginner's tutorial. If you go to our blog page, you can sign up for our free newsletter. Just a whole lot of free information on our website. In our Blue Collar Investor store, we have a large selection of online videos, DVD programs, ebooks, soft and hard-covered books, calculators, spreadsheets, trade planners, online mentoring service. Just a myriad of products that can be used to elevate our returns to the highest possible levels. So feel free to take advantage of those products as well as the free resources on our website. So that takes care of BCI podcast number 42. Why was my short out of the money put exercised? And we used a real life example with the Boeing company to make our points. Folks, I hope you enjoyed this podcast, and most importantly, I hope it puts some cash in your pocket. As always, this is Alan Elman, the Blue Collar Investor. Take care, everybody.